All right, welcome back. What a sell-off we've had today, and the shocker, of course, on crude and Saudi's move on output. Let's welcome in Paul Hicken as well as Vandana Hari, who are joining us, to kind of splice through some of that noise today and the way markets have reacted. Vandana, geopolitical tensions back in the forefront, the price collapsing, cracking that 30 mark, which was completely unanticipated and took everyone by surprise. Everyone's now trying to really work through what could be the far-reaching implications of this.
Breakdown of the OPEC, non-OPEC alliance on Friday, quite spectacular, dramatic, totally unanticipated. It caught everyone off guard. So the bloodbath that you're seeing in the market today, to some extent, is not a surprise, because what the market is now factoring in is the worst case scenario. Some looking back to what happened over 2014 to 2016, when demand was anemic and lots of oil production was coming on to the markets. However, the one thing that perhaps we are missing in this picture is that the market right now is functioning, I would say, perhaps on about 25% information and 75% fear, panic, and conjecture. Yes, the Saudis have sent a message to the market by slashing their crude prices for the month of April. But look, we haven't had any formal communication from OPEC. Maybe that's deliberate. Maybe that's a tactic on the part of Saudi Arabia. But I would say all said and done, belt up for high volatility. We've already seen Brent swing between $31 and $38 in the space of the past few hours. So, the market doesn't really have a clear view of how this is going to fall out.
Paul, what is Saudi Arabia trying to achieve? My understanding, Paul, is that the cost of production for Saudi Arabia is north of $70. Why would they sell something which they're producing at $70 at $30? I mean, it's like saying that I'm selling the house I own at half the price. I mean, how bizarre is that, Paul?
Well, you've got to remember that this is actually a result of a breakdown of relations between Russia and Saudi Arabia. This comes from that. Saudi Arabia wanted a deal. They were looking to agree a 1.5 million barrels a day production cut agreement. That Russia felt that from what we can gather, Russia felt that wasn't what they wanted at this point in time. There is some discussion whether it's related to a war against shale now from Russia, whether they were cuts were just too much. Remember, we've had ongoing cuts, perpetual cuts since 2016, and maybe that was felt that was getting too much for Russia, especially with coronavirus and what impact that's had on demand, and whether actually a supply-side response is really the most effective way forward. And as a result, we're in a situation where Saudi Arabia is now thinking, well, if it is a market share battle, if we're back to that level, then this is one way to do it. Whether it's also a negotiating tactic as well, because remember, at the same time, when the dust settles on all this, when the conflict between what's gone on Friday settles, is there a potential to mend fences here? Is there a potential with prices falling as they have done at some point down the line to get Russia and Saudi back at the table and agree some kind of deal that makes sense? This is the questions really on all the market's lips right now.
Vandana, we've been hearing a variety of things. We've got Fateh Birol coming out and talking about trying to be a little reassuring in the sense that shale producers will manage to show their resilience. China's, of course, going to benefit on the back of this as a huge chunk of demand comes from there. India, while the government's balance sheet may benefit, we're not sure how else this is going to help in terms of equity markets. I mean, just run us through some of the immediate implications.
So this is an age-old question. Where should oil prices be so that they benefit both the consumer as well as the producer countries? In the current environment, obviously, countries like China, India, especially major buyers, but also major importers and countries with a very strong demand growth should have normally been in a position to benefit. However, we have to take the coronavirus situation into account, but it's not affected India as much, but it certainly has hit China. Picking winners and losers in the current situation is not that easy. I also believe that long-term implications of the producers' economies suffering, taking a blow like this, are going to be bad because they'll have to find ways to recoup those losses down the road. I don't really see any clear winners or losers in this situation. Had the coronavirus not been around, perhaps it would have been a good story for consumers.
Crude, and we're trying to understand why Saudi Arabia has really set cat amongst the pigeon. Are they trying to kill the shale gas production here? Are they simply trying to ensure that alternates don't come on stream, alternate sources of energy? Or this is a pure function of how they're trying to gain market share, and then after 2 years from now they will be able to increase prices? We don't know yet. But crude and this kind of a dislocation surely will have impact on the way of financial markets would move, because everything is connected. And Mubina is going to summarize for us that what has been the quantum of the sell-off and what has made Dalal Street worried. And Mubina, for 20 years I've been tracking markets. There's one correlation I always look at: crude and growth. Crude going higher, growth coming back. Crude going lower, growth going lower.
Well, when the world's two biggest oil producers go on a war of sorts to gain market share, it's obvious everybody from the commodities market to the equity market is going to sit up and take notice. In fact, it's a 30% drop in oil. This has been one of the biggest falls we've seen since the Gulf War of 1991. Though, mind you, this is not the first time we are seeing the two countries, or rather, OPEC and, non-OPEC nations indulge in a price war of sorts. It's happened in 2014 as well. But mind you, the circumstances then and the circumstances now are very different. Let me first start off with the whole bit about, the coalition meeting in Vienna, then Russia saying that, look, no, we do not want to cut output for reasons best known to them. Remember, we still do not have an official statement from Putin giving a reason as to why they've decided not to, sort of join hands and cut output by another 1.5 million barrels per day. Remember, the alliance has been a bit shaky, but nevertheless, they've always come together on common terms when it comes to crude. But this time around, you could say that the alliance has been called off of sorts, albeit temporarily. But yeah, this in turn, this snub of sorts, if you could call it that, has clearly not been taken well by Mohammed bin Salman, who almost instantly, within a couple of hours, decided that, you know what, if they want to play dirty, we will too. They've hiked production, they've cut pricing by almost 10% to a lot of their Asian customers. So it's clearly an all-out war when it comes to gaining market share for crude. And while it may not benefit them very much, and mind you, if you're looking at it from the shale perspective, I would say that the shale bit is just collateral damage of sorts, because the shale boom, many are saying, may just be over as well. The number of rigs have fallen, drillers as well have fallen, among other things. But nevertheless, we're still at 15 million barrels per day of US oil, and that's not a small amount compared to what it was in 2014 at just about 8 or 9 million barrels per day. Add to that, demand is not going anywhere. We just have it at about 100 million odd. So at such a juncture, when you're seeing demand stagnating, supply coming into the market, it's but obvious. Goldman Sachs as well believes crude may just go to $20 per barrel.
Thank you for that, Mubina. Now, let's also go across to Jayesh and get a sense of how this correlates with world growth. He's actually got some interesting charts with him, Jayesh.
So what we have tried to do is show you how the prices of oil have impacted world GDP growth as well. These are the quarterly instances where oil prices have in fact slumped more than 25%. What it actually does is the Dow Jones starts declining, and once the mothership goes down, there is no other way left. But the Nifty also mirrors some of these falls. In 2020, we have seen the first quarter so far. Both the Dow Jones and the Nifty have tanked about 10% odd. In 2018, 12% was the Dow Jones fall, while the Nifty outperformed. But this is a sole instance that we can, isolate. But the other instances, if you have a look at it, 2008, where the Dow Jones declined about 20% odd, the Nifty cracked 25%. In 2008, September, 4.5% was the Dow Jones fall, while the Nifty also fell 3%. Let's have a look at, how the oil prices have moved on a quarterly basis. More than 25% in a quarter that I'm talking to, and it also has a negative impact on world GDP growth as well. The other plate will actually show you that instances. 2020, we are still awaiting the world GDP number, but oil prices have cracked more than 50%. In 2018, 38% was the price crack in oil, and the world GDP also contracted 14% and the other instances in 2014 and multiple instances in 2008. 2008, especially if you have a look at it, 55% is what oil prices declined in a quarter, and we in fact slipped into negative GDP growth. That was the 3.75% negative that we had during this year. So essentially what we are saying is that, oil prices going down will actually have a negative impact on world GDP, and therefore, have an impact on the Nifty as well as the Dow Jones.
But Shankar Sharma, First Global, is of the view that one should put buying instead of risk buying. You also see stock specific opportunity which is now kicking in some of the small cap stocks.
In terms of strategy, we saw a pretty decent fall globally and in India, of course, coming up, which we implemented the first week of February. So, while it is obviously absolute meltdown, what we were seeing was that alternates away from equity will do better, and which is what you're seeing right now. Gold has done better, fixed income has done better. So we basically pivoted out of equities first week of February. So far, that thesis has been borne out by what we are seeing right now. To answer the question, does it get any worse? Things can have a force of its own, and they can, it's just like a big boulder sliding down, a mountainside. I mean, just gathering momentum as we go. It is not looking pretty as we are all taking the screen.
Shankar, you also have a lot of market experts, and they're also predicting a fairly gloomy scenario from here on, talking about a recessionary scenario across the globe. Are there fears of that as well?
Well, I mean, if you take broad estimates, crude doesn't go to 30 like this without a recession being in the works. Number one. Number two, obviously most of the listeners to this interview are going to be in India. So let's focus on India. The world was anyway in pretty good shape prior to this. It was the problem spot was India, where we were seeing 15, 20-year lows in terms of growth rates. On top of the already very, very weak economy, we have a problem like this. And that is what is worrisome, that it was not as if India was growing 8% and then you'd see a 2% cut and you'll go to 6%. You are growing 4.5%, maybe. I mean, that's also exaggerated. Maybe you're going at 2.5% and you get a cut like this. Maybe you lose a 1% point on growth, maybe 2% points. Then where does that leave you? And remember, again, I'm putting the context in. This is all happening at all-time highs on the Indian markets, at least in the narrow markets like the Nifty and the Sensex. It's not.
All right, we're going to take another very quick break. When we come back, we'll take a closer look at the kind of wealth erosion we've seen so far in 2020 and also, of course, the kind of sell-off we saw today. Stay tuned. Well, the kind of sell-off we saw today was also extreme when it came to the blue chips. We saw massive wealth erosion, and in fact, Varun's now taking a look at the kind of erosion that we've seen so far in 2020. Varun?
So, it's been a bloodbath of a day here, but we're looking at it from a yearly standpoint. Now, Reliance has been the largest loser, 2.59 lakh crores. But if you want to stack that up, they actually lost close to 1 lakh crores just today, because at a 7 lakh crore market cap, they were 12% down. So they effectively lost 80% of HDFC's annual loss today. Now, HDFC Bank coming in second has lost around 1,06,000 crores in market capitalization. TCS following closely at 79,000. Let's remember also briefly today, TCS overtook Reliance as India's largest company. ITC following next, and you have HDFC Limited, the housing finance unit, down 70,000 crores. SBI following suit with 70,000 crores. ONGC at 66,000 crores. And ICICI Bank at 56,000 crores. So again, Reliance lost maybe 1.5 times or 1.2 times ONGC today. Overall, this comes to around 12 lakh crores of value loss erosion. A huge figure. It'll be really interesting to see whether this is just the beginning or the end, and whether these indices will be able to make up all this lost ground as the year moves on.
Okay, let's get a few more views. Atul Suri spoke to us earlier today. Let's get his perspective.
I personally don't think that the trend has reversed. What also I feel is that you are seeing a very sharp knee-jerk reaction. It's something that is pretty contagious across asset classes. So, it's not just about equity or Indian equities. I know we tend to look at narrow in our world, but this is much larger, and it is also the correlation between asset classes. It all starts with bond yields, and then we had something with crude. Of course, the triggers being coronavirus or whatever that there is. So I feel that there is a readjustment happening, but this readjustment is not orderly. It is just a one-off panic. It's, unwinding of longs or leverage trades and things like that. I personally think that these are fast moves. Just as these moves are fast on the downside, they can also have sharp pullbacks. Not that I'm predicting it will pull back from here, but these are not plays which are structural in nature. These are more panic and shock moves that there are. So I personally think that I wouldn't say that the trend is violated or something of that sort. Yes, there is panic. Yes, the screen is bad. But I wouldn't panic and sell out or do that at this stage, because I personally think that when nerves cool off, even the pullbacks can be very sharply. But when the nerves cool down is a question, yes, which is very difficult to answer in a day like this. Yeah.
Okay, now Atul, let's understand what should one do and what should one not do. You've been investing and trading this market for 30 years now. I've been commenting on markets for 20 years now. If we pour in our collective experience, we've seen that days like this in hindsight would be considered as a viewing opportunity. Is that right?
Yes, it is right. But Nikunj, the thing is that the question is that am I out there to catch the bottom? I personally think that trying to catch the bottom is going to be very, very dangerous in these times. One should give the market a day or two to stabilize. Wherever it stabilizes, it does today, 3 days later, 1 week later, we don't know. But a little bit of stabilization is important. We may not catch the absolute bottom. We may be somewhere near there. Even that will be good enough and rewarding. So I wouldn't go and deploy the cash that I have right now. I would actually wait the market to stabilize a day or two or three before one really has a base building. Because right now the tempers are very hot and emotions are running very high. Things can go a little haywire in the short term. So one should just avoid to ride the storm in the short term. Hello?
Don't know. Yeah, I'm there, Atul, and we can hear. Atul, the point I want to just bring out here is that you don't know in today's so-called program and AI world what is correlated and what is not correlated. With crude going down, what impact it could have on equities? Have equities fallen before crude, or the full crude sell-off will intensify, sell-off in equities more? Because programming and algorithms now will force you to do risk management. You don't know what's coming next.
Absolutely. I totally agree with you, that you do not know what's coming next simply because of the correlation of asset classes. I mean, this game of what I'm seeing in the last is not about Nifty. It's not about Bank Nifty. It's not about EMs. But I think it's across the board, all asset classes and the global hedge funds, which play across macros. They influence each other asset classes. So I think that play is happening out, is panning out, and it's extremely complex. At the end of the day, as an investor, what I can actually only do is to be focused on my portfolio, be in stocks which I think are relatively superior fundamentally. Where is the base? Would I go and pick the bottom? The answer is no. Yes, at some stage things will stabilize and we will get a chance. Will it be at the absolute bottom? No. But even if we are able to ride through the storm and be able to deploy cash at a little more sensible time or cooler time, I think that's good enough. Things are difficult, things are tough. The pain point is the place where there is leverage. And fortunately, we don't have leverage. So it is painful, yes, but one can ride the storm. And that's more important. At this stage, it's about riding the storm rather than trying to pick the bottom.
We also spoke to Bala, and let's hear out what he had to say.
Clearly, today's fall in the market is one on account of yesterday's fall in the Kuwait and the UAE market, and also the oil price crack. And the Dow future is reacting purely related to the oil price crack. I think the oil price coming to about $30, and assuming a scenario it stays like this for between $30 to $40, it can immensely benefit India, and India being one of the heavy dependent on oil price, oil as a commodity. Therefore, it can benefit India. And today's fall is actually quite sharp. Of course, it's quite obvious on the back of the reason which I just mentioned earlier. From investors' point of view, we normally advocate investors to look at SIP way of investing. While that continues to remain, investors at this point of time can consider reasonably big time to look at the even lump sum investment at this point of time. And having said that, of course, one should also keep in mind the oil price drop, while it can benefit India, can also have the potential of taking the global economy to some bit of recession. And therefore, we may probably see a low interest rate regime prevailing, and central bankers actually looking at more favorably to cut rates further and also provide liquidity more into the system. And India as a country have already been doing all these things quite continuously the last 3-4 months. Assuming a scenario, the government is able to actually now quickly react and get back on the drivers of growth, especially related to the auto sectors, the revival in the form of coming with scrapping policy. All such things can come at this point of time. The government has been quite conscious about this for quite some time. Therefore, it can potentially turn out to be a winning situation for India. And given the fact that oil has been the bigger dynamic driver for from India point of view.
Okay, I just want to understand from you, Bala, it's a bit of a divided opinion when it comes to whether or not one should deploy money into the markets right now, because the variables seem ever so uncertain, and day after day we're seeing this panic selling hit the markets. Do you believe that right now is the time to buy into the markets, or would you wait for some amount of stability, some amount of clarity to kick in before actually deploying money?
Of course, if you look at the way I think the market price have fallen today, it's quite sharp. When you look at some of the individual names, pretty sharp, which is nothing but just one-time sell-off that's come from investors, from overseas investors, I would assume, and also some bit of investments in selling would have come from domestic as well. But such a sharp fall, I've always seen historically, does not sustain for too long. And also today's fall has come on the back of series of fall which has happened in the market for the last 2-3 weeks. Therefore, keeping this in mind, I would assume if somebody has got 100 rupees to invest, at least 30 to 40 rupees should be considered as a form of the lump sum investment, with the assumption that market is not going to go back to its bullish territory too fast. Therefore, one will get an opportunity to invest even gradually as we move forward. But having since a sharp fall, maybe it could be good time to consider investing.
Let's take another very quick break. We'll be back and also analyze some other key historical trends. So this is one of the biggest falls we have seen in recent times. Back in just a moment. Welcome back. Let's go across to Pankaj now. He's taking a look at the Nifty peak, PE, and the market bottom PE, and the kind of difference that we have now. Pankaj?
What we've tried to do is we've tried to analyze the previous few falls that you've seen in the market, which is more than 10%, and try to analyze that where essentially the markets did top out in terms of PE, and where essentially they bottomed out. So this is of course the current one, but we'd like to just explain. Last 3 times you saw 19 times is when the PE got topped out, but the bottom was 16 to 16.5. And this time around, right now, it is 15.4. We don't know whether it's a bottom or not. Of course, we'll only come to know it in hindsight, but it topped out around 18.6, and the current levels are 15.4. But the last 3 times is interesting because it's been at 16 times level where you saw the markets being higher. So we went down much further and tried and see, which are essentially some of the other cases in this last entire 1 decade where markets have fallen by greater than 10%. And then essentially, you've seen a fall coming in, or, try to do a market recap. So we'll just put that up for you. So that's, there you go. In March 15th to Feb 16th, there was a big sell-off. 14.2 times was the number where you actually bottomed out. Of course, Jan 2008 was an exceptional event. 7.6 times is where the bottom happened. And in November, when you had that entire default issues from various players, 11.6 times is when that bottom happened. So these are some of the other 3 instances where you have seen. Currently, it's at 15.2. Last 3 corrections, 16 times is when the markets had bottomed out. But you can see it earlier as well. It's gone down to as low as 8 times when it was October 2008. And when you talk about Feb 2016, it was as low as about 14.2. 1.2 times.
All right, thanks for that, Pankaj. And Vivek, what have been some of the big falls in the market over the last 10 years?
So what we at ET Now have done is that we've actually analyzed when the Nifty or the global markets have actually seen such sharp drawdowns that we've seen recently. So what we've actually done is we've gone back as far as up to 2008. Now remember, in 2008 we saw the global financial crisis, the housing bubble that burst, and we saw a drawdown of over 50%. And after that, markets went up steadily after the recovery from that particular one. And then once we came to 2011, 2012, we actually saw the flash crash as well as the Greece market crisis. Now remember, on the back of that, again, you saw a drawdown of a little over 20%. Now after that, what we actually saw, we actually saw quite a few rosy years, post which the single biggest fall that we saw was due to the China currency devaluation. A lot of market participants felt that this was done on purpose and it was a manipulation as far as trade was concerned. After that, again, you saw a fall of over 15%. You also saw demonetization, again, a significant fall that was seen as far as Indian markets, and it was quite local when in terms of how the fall was actually seen. Post which, if you're talking about the fall was seen after the imposition of the LTCG in the budget. And because of that, again, you saw a fall of over 10%. You also saw the IL&FS, when you're talking about the debt crisis that broke out as far as IL&FS is concerned, and the NBFC crisis. And also, when you're talking about the last two big candles that you're seeing right at the end, the first one is due to the coronavirus breakout. Global trade, global manufacturing activity has taken a significant beating. And, the recent one, or the latest one, is due to the non-compliance or the non-agreement of OPEC plus producers to reach an agreement as to how much oil to supply, on the back of which, again, you saw what is essentially a historic day in today's markets, historic for all of the wrong reasons, single biggest intraday point fall as far as the Nifty is concerned.
Thanks for that, Vivek. We're going to leave it there on the show. Special programming brought to you to really take you through some of the key, perimeters that collapsed today, as well as some of the biggest voices on the sell-off that we saw. We're going to stay on top of that right here on ET Now. But for now, it's a goodbye from all of us and wishing you a happy holding.